Hey there, curious minds. Have you ever paused to truly consider one of our most fundamental senses, hearing?
Hmm.
It's something, we often take for granted until it's challenged.
Absolutely.
And the reality is, hearing loss is a silent epidemic impacting millions globally. We're talking about, well, a staggering 1.5 billion people worldwide currently living with some form of hearing loss.
It's a huge number.
It is, and that figure is projected to swell to nearly 2.5 billion by 2050.
Wow.
Yeah, with over 700 million of them requiring some form of rehabilitation. It's a profound human challenge,
Think
really.
definitely.
And today, we're diving deep into a company that's right at the very forefront of helping people reconnect with the vibrant world of sound. Our mission today is to unpack a comprehensive investment analysis on Demant AS. Now, this isn't just about the mechanics of stocks and shares,
Right. It's much broader than that.
It's about understanding a really fascinating industry, one that's driven by powerful long-term demographic shifts and, well, cutting-edge technology.
Mhm.
We'll be exploring Demant's strategic position, how it balances these robust long-term market fundamentals against current operational challenges,
Uh-huh.
and its ongoing integration of its largest ever acquisition. That's a big
And
piece.
what's truly compelling here, I think, is that demand finds itself at a critical strategic inflection point,
Mm,
a real crossroads.
okay.
So we'll be meticulously examining the compelling long-term opportunities that stem from those incredible demographic tailwinds you just mentioned,
Yeah, there's massive numbers.
but also, importantly, the very real risks and near-term challenges it faces. Particularly with a significant acquisition now in play, it's a remarkably dynamic picture.
So lots to unpack.
Indeed. And it leads us to a core question, really. Can Demand's focus strategy navigate these hurdles, successfully integrate its ambitious acquisition, and ultimately deliver sustained value? Not just financially, but to the millions who depend on their innovation.
Right. That's the puzzle we're trying to solve today. So let's begin by understanding who Demant A truly is. This isn't some fleeting tech startup, is it?
No, not at all. This is a company deeply rooted in history. We're talking origins back to 1904.
Over a century.
Exactly.
Yeah.
Founded in Denmark by Hans Demant. And it was driven by a deeply personal mission, actually.
Oh, really?
Yes, his wife suffered from severe hearing loss,
Hmm.
and he wanted to help her. He started by importing early hearing aids, but, quickly realized the need for superior custom solutions. And that deeply personal origin story, it isn't just a historical footnote. I think it fundamentally shaped Demant's corporate culture for, well, over a century now.
Hmm.
It instilled this continuous focus on empathy, innovation, and a real commitment to improving individual lives. And that transformed it from a small family-run operation into a global powerhouse.
A powerhouse is right.
Today, Demant boasts an immense global footprint, present in 130 countries, employing over 22,000 dedicated people worldwide.
That's an impressive reach. And you mentioned the family aspect, which brings us to Demant's ownership structure. Now, in today's fast-paced corporate world where, quarterly earnings often dictate strategy.
Well, absolutely, short-term pressures.
Right. How does having a patient foundational owner like the William Demant Foundation truly shape Demant's strategic choices
Hmm.
and its ability to navigate volatile markets compared to, say, a purely public company driven by those short-term results?
That's a critical distinction. The William Demant Foundation, through its investment arm, holds a majority stake, about 56%.
Over half.
Yeah. And this isn't merely a large shareholding, it's a strategic bedrock.
Yeah.
This foundational ownership structure profoundly influences their approach. It allows for long-term strategic focus rather than succumbing to those short-term market pressures.
So they can think longer term.
Precisely. It underpins their capacity for significant long-horizon investments in crucial areas like research and development. R&D is absolutely vital in this technology-centric industry.
You need that investment.
You do. And this stability provides the resilience and foresight needed for major strategic pivots and sustained innovation, things that short-term driven companies often struggle to prioritize.
Makes sense.
It really empowers management to pursue sustainable, long-term value creation.
That perspective on long-term investment really highlights a unique advantage. And speaking of long-term thinking, Demant's competitive strength seems deeply rooted in something they call vertical integration. Can you tell me, how does this vertical integration actually play out on the ground?
Okay. Yeah.
It sounds like they control almost every aspect from the initial diagnosis right through to the customer's ongoing care. That's quite a comprehensive model.
It truly is. Demant operates across three core business areas that, well, collectively cover the entire hearing health value
The
chain.
whole chain.
Yeah. And this creates what we describe as a powerful competitive moat. First, you have hearing aids. That's their wholesale manufacturing arm, producing highly recognized brands like Oticon and Bernafon.
Okay, the devices themselves.
Exactly. Second, there's hearing care. This
Ah.
is their extensive global network of retail clinics,
Mm.
operating under names like Audica and Hearing Life.
So the places you go to get fitted.
Right. And finally, diagnostics.
Mhm.
This is where they manufacture sophisticated audiological equipment under brands like Inner Acoustics,
That.
the tools the professionals use.
So from the diagnostic tools doctors and audiologists use to assess hearing, to manufacturing the actual cutting-edge hearing aid technology,
Mhm.
to selling it directly to you in their own clinics, that is a remarkably robust setup.
Yeah.
How do these seemingly disparate segments connect and create that synergistic loop you mentioned? What's the strategic depth of that moat?
Well, this integrated structure isn't just about efficiency, though that's part of it. It means Demant can rapidly iterate products based on real-world clinic feedback.
Ah. Oh,
In a way, non-integrated players simply can't. It
Mhm.
creates this continuous closed-loop innovation engine.
a feedback loop.
Exactly. Think of it this way. The diagnostic segment provides the tools used by professionals who prescribe and fit hearing aids. This gives Demant immediate, granular insight into clinical needs, emerging trends in hearing care, and specific professional requirements. Armed with this invaluable data,
Straight from the source.
the hearing aids segment then develops and manufactures its core products, leveraging extensive R&D capabilities to directly address those identified needs.
Makes sense?
And finally, the hearing care retail segment provides a captive, high-margin distribution channel for those very products.
Ah, so they guarantee a place to sell them.
Precisely. This ensures direct, controlled access to the end user. It allows Demant to capture the full value of that customer relationship, from initial diagnosis and fitting to ongoing care and support.
So it's not just about selling a product, it's about owning the entire customer experience and gleaning insights at every single touch point. That truly makes them incredibly agile and responsive. Sounds like a formidable barrier to entry in a tech-driven market.
Precisely. This integration allows for extensive sharing of resources across R&D, manufacturing, and marketing. That leads to significant operational efficiencies.
Right.
But the real strategic advantage, I'd argue, is the holistic understanding of the market that it fosters. An understanding non-integrated competitors simply lack.
They don't have that full view.
No. So Demant can respond faster to market needs, optimize product development based on direct feedback from their own clinics, and secure immediate distribution for their innovative products. It ensures new technologies reach customers quickly and effectively.
Now, let's zoom out a bit to the broader market Demant operates in. The investment case for Demant is really underpinned by some undeniable long-term catalysts. We mentioned it earlier, but the global aging population is a core, non-cyclical driver for this industry.
It raises a fundamental question, doesn't it? How many industries have such a clear and powerful demographic runway for decades to come?
Not many, I'd imagine.
Exactly. The sheer scale of projected hearing loss ensures a durable and expanding addressable market, which is, a rare structural advantage.
Yeah.
According to the World Health Organization, the number of people with hearing loss is projected to nearly double, from 1.5 billion today to 2.5 billion by 2050.
2.5 billion people.
Yeah, with over 700 million of those requiring rehabilitation. This isn't just a trend, it's a certainty driven by global demographic shifts. As lifespans extend, the prevalence of age-related hearing loss naturally increases.
Those numbers are truly staggering. It means demand for hearing solutions is practically guaranteed to grow for decades. Creates a very resilient market.
Absolutely. And this translates directly into robust market growth estimates. Analysts generally peg the global hearing aids market size somewhere between, say, USD 10 billion and USD 20 billion.
That's a big range.
It is. Depends how you measure it.
Yeah.
But the consensus projected compound annual growth rate, the CAGR, is in the range of 6% to 10% for the coming years.
Still very healthy growth.
Very healthy, yes.
Okay.
This represents a highly attractive and resilient market that provides a strong foundation for Demant's long-term strategy.
Beyond just the sheer number of older adults, what other forces are contributing to this steady growth? Are there technological advancements making a real difference?
Yes, definitely. There are several powerful secondary growth drivers at play. Ongoing technological advancements are a major accelerator.
Like what kind of tech?
Well, we're talking about things like AI-driven sound processing that adapts to complex listening environments in real time, Imagine your hearing aid intelligently filtering out restaurant chatter while enhancing your companion's voice.
Yeah, that's smart.
It is. There's also seamless Bluetooth connectivity. That transforms hearing aids into advanced personal audio devices, allowing direct streaming from phones or TVs.
So more than just hearing aids.
Much more. Furthermore, ever-improving comfort and aesthetics make devices almost invisible. That reduces the stigma often associated with hearing aids.
That's a big barrier for some people.
A huge barrier.
Yeah.
So these innovations don't just improve hearing, they enhance the entire user experience, making devices more effective, more appealing, and ultimately driving wider adoption among various demographics. And beyond the tech, there's growing public awareness too. Awareness of the profound health consequences of untreated hearing loss. That encourages earlier intervention.
People are realizing it's linked to other things.
Exactly. People are increasingly understanding that it's not just about hearing, but about cognitive health, social connection,
Right.
and finally, improving healthcare access and reimbursement systems, particularly in emerging economies, are expanding the addressable market even further, making these crucial devices accessible to more people.
So Demant has built this remarkably robust foundation, powered by undeniable demographic tailwinds and a clever integrated business model. But, building a strong ship is one thing, navigating through stormy seas and strategic shifts is another. Which brings us directly to how Demant is actively transforming itself to meet future challenges. It seems they're not just expanding, they're also getting leaner, shedding parts of the business that weren't pulling their weight. It's like a strategic spring cleaning for a global corporation, right, with a potentially big payoff.
That's a very apt analogy. Demant has undertaken a deliberate strategic pivot to sharpen its focus on its most profitable and synergistic core businesses.
Makes sense.
A pivotal move was the decision back in 2022 to discontinue its hearing implants business.
Ah, okay. Why was that?
Well, while that segment provided advanced solutions, it was quite capital intensive and, frankly, less integrated with their core wholesale hearing aid and retail operations.
Didn't fit the model as well?
Not as neatly, no.
Yeah.
So this divestiture was a strategic streamlining of the company's portfolio, aimed at improving its overall profitability profile and, crucially, allowing management to concentrate precious capital and R&D resources on the larger, more synergistic hearing aid and retail markets, where they possess clear competitive advantages.
And it wasn't just divesting. They also had a non-core division, communications, which operates under the EPOS brand. That was actually a significant drag on profitability, wasn't it?
Right.
Reporting an EBIT loss of, DKK $358 million in 2023?
A substantial loss, yes.
But they didn't just dump it. They turned it around.
Precisely. Management demonstrated their operational prowess here. They successfully executed a turnaround, returning the EPOS business to profitability in 2024. It underscores their capability to manage complex assets. Now, a strategic review is underway to explore a potential further divestment of this segment.
So it might still go.
It might, which, again, would even more sharply focus Demant on its core hearing healthcare operations. This strategy of focused consolidation is clearly aimed at optimizing their resource allocation and maximizing returns from their primary strengths, rather than diluting efforts across tangential businesses.
And this leads us to what you called a strategic inflection point earlier, the game-changing acquisition of Kind Group. This wasn't just any acquisition. It was Demant's largest ever deal.
Indeed. The acquisition, announced in June 2025, involved the purchase of Kind Group for a total consideration of EUR 700 million. That's approximately DKK 5.2 billion.
Wow.
This isn't just about adding scale, it's a profound strategic chess move that could really reshape the competitive dynamics of the European hearing care market.
That's a massive amount of capital. What exactly is Kind Group and what makes it so valuable for Demant?
So, Kind AD is a premier hearing care retailer, a very significant player with approximately 650 clinics. Now, what makes it particularly strategic is that the vast majority of these clinics, around 600, are located in Germany.
Ah, Germany, key market.
One of Europe's largest and most important hearing aid markets, yes. They also employ about 3,000 skilled professionals. So this single transaction will have a truly transformative impact on Demant's retail network and its competitive standing.
How so? What does it mean for Demant to bring Kind A under its umbrella, especially in a market like Germany?
Well, first, it will dramatically expand Demant's global retail network to over 4,500 clinics, instantly boosting their scale and direct customer reach.
Huge jump in footprint.
Huge jump. Second, and perhaps even more strategically important, it cements Demant's dominant position in the German market. which is incredibly significant given its size, roughly 1.7 million hearing aid units sold annually there. It's a market characterized by a well-established professional channel and strong reimbursement.
So it's about scale and market leadership. But you mentioned a strategic chess move and an offensive and defensive play. Can you elaborate on that? What are the broader implications for the entire industry?
Absolutely. The hearing aid market is dominated by these few, large, vertically integrated players, what we often call the Big Five.
Right.
And independent retail chains represent a critical but shrinking battleground for product distribution. Kind was one of the last large-scale independent hearing aid chains left in Europe.
Yeah, okay. So taking them off the board.
Exactly. By acquiring Kind, Demant executes both an offensive and a defensive maneuver that sends ripples across the industry.
Let's break down the offensive part first. How does this move position Demant to gain ground?
Offensively, it dramatically increases Demant's own retail footprint and secures a vast, high-volume, high-quality distribution channel for its manufactured products, specifically its Idacon and Bernafon brands.
Got it.
It provides them a direct, controlled pathway to millions of customers who might otherwise have been served by independent retailers carrying competitor products.
Locks them in, essentially.
It helps. This allows Demant to better control the customer experience, gather direct feedback, and ensure their latest innovations are expertly fitted and supported.
And the defensive aspect. That sounds like they're protecting their turf and making things tougher for rivals.
Exactly that. Defensively, it removes a major distribution platform from the open market. That makes it significantly more challenging for competitors like Sonova and GN Store Nord to place their products in the crucial German market.
Fewer options for them.
Far fewer large options. This forces those competitors to either rely on a diminishing pool of smaller, often less sophisticated independent retailers,
Right.
or invest heavily in building out their own retail presence, which is a costly and time-consuming endeavor.
Increases the barrier.
Fundamentally, it increases competitive friction and capital intensity in the market, effectively raising the barrier to entry for securing direct customer access. It strategically secures a substantial portion of the German market for Demant's own brands, reinforcing the power of its vertically integrated model. Makes it much harder for others to compete for those customer touchpoints.
Wow.
It's a powerful statement about their commitment to controlling their distribution. #tag33. Navigating the competitive gauntlet and financial headwinds.
That really reinforces the power of vertical integration and securing that direct line to the customer, especially in such a competitive Big Five landscape. Let's delve deeper into that competitive landscape. The hearing aid industry is what's known as an oligopoly, right? Meaning it's highly concentrated, dominated by just 5 major global players: Sonova, Demant, WS Audiology, GN Store Nord, and the privately held Starkey.
That's correct. And this structure leads to intense but generally rational competition.
Rational, how so?
Well, these players typically avoid aggressive price wars that would just undermine the entire industry's profitability. Instead, the focus is primarily on technological innovation.
The features race.
Exactly. Who has the best sound processing, the most seamless connectivity, the most comfortable design, alongside brand strength and, crucially, effective distribution channels? Each player strives to differentiate through cutting-edge features and a strong market presence, constantly pushing the boundaries of what hearing aids can do.
And how does Demant stack up against these powerful peers? When we look at their financials, we sometimes see slightly different metrics being reported. Can you give us a brief comparison of their competitive standing and maybe acknowledge those differences in reporting?
Certainly, yeah. Comparing profitability across the Big Five, you do see some slight variations in the metrics they report. Sonova and GN, for instance, often report adjusted EBITDA, while WS Audiology uses EBITDA, and Demant tends to focus on EBIT. Now, while these all offer a good snapshot of operational performance, it's useful to remember that EBITDA adds back amortization and EBITDA adds back both depreciation and amortization.
Got it. Small differences.
Small, but worth noting if you're digging into the real specifics. For our purposes, we're looking at their core operating profitability. So starting with Sonova, it's generally considered the largest player by revenue. Reported sales of CHF $3.87 billion for its most recent fiscal year, and an adjusted EBITDA margin of 20.9%. Very strong profitability.
Can I hop the back?
Pretty much. Then you have GN Store Nord, another key Danish competitor. Total revenue of DKK 18.0 billion. Now, their overall EBITDA margin was lower at 12.0%, but it's important to note this includes their audio division. Their hearing division often performs better on its own.
Ah, okay. Need to separate that.
Yeah. And WS Audiology, a private competitor formed for the merger of Widex and Savantos, reported strong organic growth of 10% and an EBITDA margin of 20.6%. So right up there with the profitability of the market leaders.
So Demant's playing in a very high-stakes competitive environment.
Absolutely. Consistent innovation and efficient operations are paramount.
It certainly sounds like it. But even a company in an industry with such strong long-term tailwinds and a robust strategy can't entirely escape the realities of consumer sentiment and broader market dynamics, can they?
No, they can't.
Let's look at Demant's recent financial performance, which has shown a period of volatility and some undeniable headwinds.
That's a crucial point. Looking back from, say, 2020 to 2024, Demant's financial journey has been quite a roller coaster, reflecting those global economic shifts.
Right. COVID hit everyone.
Exactly. In 2020, revenue declined to DKK 14.47 billion due to the unprecedented global COVID-19 lockdowns. Shut down clinics, deferred non-essential healthcare.
Yeah, I remember that.
But then came a powerful rebound in 2021. Revenue surged 23.8% to DKK 17.91 billion.
Huge jump back.
Huge. This exceptional growth was fueled by pent-up demand as clinics reopened, alongside the significant impact of a major hearing healthcare reform in France that increased accessibility and reimbursement.
So, a strong recovery. But did that momentum last consistently, or did they hit some bumps after that initial surge?
Well, growth continued robustly through 2022-2023, reaching DKK 19.71 billion and DKK 21.60 billion, respectively. So that showed the underlying strength of the market.
Okay.
However, in 2024, growth moderated significantly to 3.8%, revenue of DKK 22.42 billion. They faced tougher year-over-year comparisons and a more intensely competitive market environment.
Growth slowed down.
It did. Profitability also saw swings. The adjusted EBIT margin was strong at 19.6% in 2021, contracted to 16.3% in 2022 due to macro pressures like inflation, supply chain issues.
It has all that turmoil.
But then recovered to 18.5% in 2023 and 19.6% again in 2024.
Yeah.
So that demonstrates their ability to manage costs and pricing.
Given that history, what does this all mean for their more recent performance, specifically the first half of 2025? That drop in profitability on essentially flat sales.
Yeah.
That's quite striking, isn't it?
What's truly fascinating here is the sensitivity of Demant's financial model. As starkly evidenced by the first half of 2025, the group reported flat organic growth, 0%.
Zero growth.
Zero organic growth. Total revenue of DKK 11,253 million. But even more concerning was the deterioration in profitability. EBIT before special items declined by 11% year over year to DKK 1,849 million.
Ouch.
Yeah. Causing the EBIT margin to contract by a significant 2.3 percentage points down to 16.4%. That is a clear red flag.
That sounds like a substantial hit to their bottom line. What were the specific reasons management provided for this pronounced weakness?
Management attributed these weaker results to a combination of factors. They pointed to softer than expected global market growth, persistent consumer cautiousness in the U.S., which is a really key high-margin market for them.
Right, the U.S. is crucial.
Very crucial. Also, the unfortunate loss of sales to a large U.S. retailer, and critically, unfavorable geographic mix changes.
Mix changes, meaning where the sales happen.
Exactly. This last point meant a shift in where sales were occurring, creating negative pressure on average selling prices, or ASP.
So if they sell the same number of units, but those units are sold in different regions or through different channels that offer lower prices, it can have a disproportionately large impact on profitability, even if top-line revenue seems stable. This concept of negative operating leverage seems to be at play here. Can you elaborate on why that's so impactful?
Precisely. The H1 2025 results clearly demonstrate a crucial sensitivity in their financial model. Think of Demant's significant fixed costs, the extensive R&D investments, the global retail infrastructure, the marketing spend.
All those big overheads.
Right. When sales volumes flatten, or more critically, when the mix shifts towards lower average selling prices, as we observed in H1 2025, those fixed costs are spread over a smaller or less profitable revenue base.
Got it.
This means each dollar of sales now has to bear a heavier burden of overhead, leading to a disproportionate contraction in the operating margin. This negative operating leverage is a primary risk to their goal of margin expansion, because a decline in high-margin revenue can significantly compress group-level EBIT margins.
So it really bites.
It really does. It highlights how vulnerable their profitability can be to external market dynamics and sales channel shifts, even when unit growth remains positive.
Let's break down the individual business segments then to see where these pressures and strengths are truly coming from. The combined hearing healthcare engine, encompassing both hearing aids and hearing care, seems to be the primary revenue and profit driver.
It absolutely is. In 2023, this combined business generated an impressive revenue of DKK 21.6 billion, with strong EBIT of DKK 4.5 billion and an EBIT margin of 20.9%, underscoring its importance to the group.
Okay.
Within that, hearing aids wholesale had an exceptionally strong 2023, largely driven by the successful launch of their innovative Oticon Real product platform
Right, the new tech.
and significant market share gains, particularly in the competitive U.S. market. However, this momentum stalled in H1 2025. External revenue saw an organic decline of 2%.
So going backwards slightly.
On the wholesale side, yes. Now, total unit growth was positive, 3% indicating people were still buying devices. But this was entirely offset by a 2% decline in average selling prices.
Ah, that mix effect again.
Exactly. That ASP decline was due to the unfavorable geographic mix, the loss of a key U.S. managed care contract, and reduced sales to a large U.S. retailer. Lots of U.S. pressure there.
So the wholesale side faced some serious headwinds in the first half of the year. What about their direct-to-consumer retail arm, hearing care? Has that provided more stability?
Hearing care retail has been a more consistent and crucial driver of growth and stability for Demant. It delivered solid performance through 2023 and generated 7% organic growth in the second half of 2024, provided a vital stabilizing force against those wholesale fluctuations.
It's good to have that balance.
Very important. In H1 2025, it continued to outperform the wholesale business, posting 2% organic growth, further supported by ongoing bolt-on acquisitions that expand their clinic network.
Still growing, but slower.
Slower, yes. Even this segment wasn't entirely immune. Momentum decelerated in the second quarter due to, again, that pervasive consumer cautiousness in the U.S. market.
That U.S. consumer theme keeps coming up.
It does. Looking ahead, the K&D acquisition will, of course, dramatically boost this segment's scale and strategic importance, particularly in Europe.
And what about their other segments, like diagnostics and communications? How have they fared?
Diagnostics has faced persistent challenges. Throughout 2023 and 2024, it was hampered by soft market conditions and limited access to the public market in China due to broader economic slowdowns and geopolitical tensions.
Okay, external factors.
Mainly, these struggles continued into H1 2025 with a 2% organic decline, primarily due to macroeconomic uncertainties in the U.S. and China, leading to lower capital investment in diagnostic equipment by hospitals and clinics.
Belt tightening. Seems like it. As for communications, EPOS, after being that significant drag with the DKK 358 million EBIT loss in 2023,
Right.
management successfully turned the business to profitability in 2024, showcasing strong operational management there.
Good turnaround.
Very good. And as we mentioned, a strategic review is ongoing to explore a potential divestment, which would further sharpen Demant's focus on its core hearing healthcare segments.
This brings us to a truly significant development, one that has the potential to reshape the entire industry: the over-the-counter or OTC hearing aid market.
A big one.
This is a game changer, folks. Imagine walking into a pharmacy and buying hearing aids off the shelf. Much like you might reading glasses, it fundamentally changes the entire consumer pathway, or at least it has the potential to.
It truly is a seismic shift, particularly in the United States. This follows the landmark October 2022 FDA ruling that now allows adults with perceived mild to moderate hearing loss to purchase devices directly, without a prescription, without the need for a professional fitting by an audiologist.
Big change in regulation. Huge. The explicit intent behind this regulatory change was to increase accessibility and affordability for a vast underserved population.
So, what's been the initial impact? Has it completely upended the traditional market as some feared, or are we seeing something different emerge?
Interestingly, initial data suggests that the disruption to the traditional professionally fitted market has been more limited than some initially expected.
Oh, really?
Yeah. In the first full quarter following the ruling, sales of prescription hearing aids actually rose by 8.0%.
They went up.
They went up. This suggests that the OTC channel may be primarily attracting a new, younger demographic. Individuals who might have perceived their hearing loss as minor, or who were put off by the cost and perceived hassle of seeking professional care.
So bringing new people into the market.
It seems so. Rather than significantly cannibalizing the existing market for premium professionally fitted devices, OTC seems to be expanding the overall addressable market. By reaching those who previously weren't engaging with hearing healthcare at all, however, the long-term impact on market share dynamics and consumer preferences remains a key uncertainty. It's still early days.
So some of the initial fears haven't fully materialized yet, but the full picture is still evolving. Given this new landscape, what's Demant's strategy? Are they jumping into the US OTC market with both feet, like some of their competitors?
Well, what's truly fascinating here is that Demant is notably the only member of the Big Five that has consciously chosen not to enter the U.S. OTC market directly with its own branded products, at least for now.
That's a huge strategic call. Competitors like Sonova, leveraging its Sennheiser acquisition, and WS Audiology through a partnership with Sony, have already launched their own OTC products.
They jumped right in.
Right. Why is Demant abstaining from such a potentially large and growing segment? Is this a genius move to protect its high-margin professional business, or is it a missed opportunity to capture a new burgeoning market?
It's a calculated strategic risk, no doubt about it. Could profoundly define its future trajectory. Demant's decision signals a very clear bet on the enduring value of the professional audiologist-led channel.
Sticking to their knitting.
In a way, yes, and a strong desire to preserve its premium brand equity. They're essentially saying, we believe the complexity and personal nature of hearing loss mean a fully guided expert journey will always command the highest value and customer loyalty, even as convenience options emerge.
Banking on the professional touch.
Exactly. They are betting that the personalized fitting, ongoing service, and advanced features of professionally prescribed devices will continue to justify a premium price point and foster deeper customer relationships.
So they're protecting their established high-value business model and premium positioning. Makes sense from that perspective. But what are the potential downsides, the risks of not participating in the OTC market?
Well, there are several potential downsides. First, there's the obvious risk of ceding the entire entry-level market to competitors.
Letting others grab those new customers.
Potentially. If the OTC market continues to grow significantly and effectively serves a large portion of the population with mild to moderate hearing loss, Demant could miss a crucial opportunity to build a funnel of future customers.
People who might upgrade later.
Exactly. These are individuals who, after experiencing the benefits of a basic OTC device, might eventually upgrade to Demant's higher-end, professionally fitted products as their hearing needs evolve. Secondly, there's the potential for channel conflict if they were to launch lower-priced OTC products.
Competing with their own clinics.
Precisely. Could directly compete with and potentially cannibalize sales within their own extensive hearing care retail network, which relies heavily on that professional model.
And the massive Kindby acquisition we just discussed, how does that play into Demant's OTC strategy? Does it reinforce their conviction in the professional channel?
Absolutely. Demant's substantial investment in the Kindby retail network is an undeniable, powerful signal that it is doubling down on the professional channel as its primary strategic focus.
Putting their money where their mouth is.
Exactly. It reinforces their conviction that the personalized, audiologist-led experience is the path to enduring premium success. By securing such a vast retail footprint, they are reinforcing their belief that the future of high-value hearing healthcare lies in expert guidance and tailored solutions rather than a broad self-service approach.
Interesting.
It truly is a high-stakes gamble, a bet on the enduring power of human expertise and professional service in a world increasingly moving towards digital convenience. And frankly, only time will tell how this bold strategic choice ultimately plays out.
Okay, so Demant is making this clear bet on its integrated professional model and has executed a massive strategic acquisition with Castrati. Now let's talk about the money side of things. Even with the recent headwinds in H1 2025, Demant has a reputation as a robust cash-generating machine, right?
Yes, that's generally true.
But that cash is now being directed differently, and that brings us to, well, the biggest financial puzzle piece, the debt.
That's a fair characterization of their operational strength, historically. Demant maintains a strong track record of free cash flow generation. In 2023, the company generated a robust free cash flow, or FCF, of DKK 3.48 billion.
That's a lot of cash.
It is a significant increase from DKK 1.62 billion in 2022. And this strong cash flow continued into the first half of 2025, despite those operational headwinds we discussed, with FCF of DKK 1.13 billion.
Still churning it out.
Yes, it demonstrates the underlying resilience and efficiency of their business model.
So they generate plenty of cash. How do they typically allocate that capital? What are their priorities when it comes to reinvesting or returning value to shareholders?
Their capital allocation policy is quite clear and consistent. It primarily prioritizes reinvestment back into the business, specifically through R&D to maintain their technological edge.
Need that innovation.
Absolutely. And through bolt-on acquisitions to strategically grow their retail footprint, as we just saw dramatically with Kind. After those internal growth initiatives are funded, all excess free cash flow is typically returned to shareholders via share buybacks.
Buying back their own stock.
Exactly. They've had consistent buyback programs. DKK $846 million returned in 2023, a substantial DKK $1.84 billion in 2022. Notably, the company does not currently pay a dividend. They focus exclusively on share buybacks as their preferred method for returning capital.
Interesting. Why only buybacks?
It usually indicates a belief from management that their own stock is undervalued and offers the best return, or simply provides more flexibility than a fixed dividend commitment.
But I'm guessing that changed with the Kind acquisition announcement. Such a large deal must have significantly impacted their capital allocation priorities, right?
Correct. The share buyback program was explicitly suspended upon the announcement of the Kind acquisition.
Put on hold.
Yes. This decision was made to prioritize deleveraging, which brings us squarely to a significant financial challenge and a key area of investor focus. The debt load?
Okay, let's talk about that. What's the immediate and projected impact of the Kind acquisition on Demant's balance sheet, particularly regarding its debt levels?
This is a substantial financial undertaking. The Kind acquisition is projected to temporarily increase Demant's financial leverage to approximately 3.5 times net interest-bearing debt to EBITDA.
3.5 times.
Yes. And to put that in context, this is significantly above its stated target range of 2.0 to 2.5 times.
Way above target.
Considerably. This increase reflects the sheer scale of the acquisition and the financing required to complete it.
A 3.5x leverage ratio sounds like a material increase. It certainly introduces a period of heightened risk, doesn't it? What does that mean for the company's financial flexibility and vulnerability?
It means they're taking on a considerable amount of debt relative to their earnings. There's no way around that. This introduces a period of heightened financial risk, where successful integration of Kind and strong, consistent cash flow generation become absolutely critical.
Pressure's on.
Definitely. An increased debt burden reduces financial flexibility for other investments or, unforeseen challenges.
Yeah.
And it makes the company more vulnerable to operational missteps, economic slowdowns, or an unexpected market downturn during this deleveraging period.
Less wiggle room.
Much less. Now, management anticipates returning to their target range of 2.0 to 2.5x within 18 to 24 months through robust cash flow generation and diligent debt repayment. But that 18 to 24-month window is a key execution period for investors to watch very closely.
So the market is essentially saying, we recognize your quality, Demant, but show us you can pull off this latest big move and navigate these choppy waters with a heavier debt load. It's a fascinating dynamic. How does the market currently value Demant, given all these strategic moves, financial shifts, and competitive pressures?
Assessing Demant's valuation requires looking at it from multiple angles to get a complete picture. On a forward-looking basis, Demant often trades at a premium compared to the broader medical equipment sector and some of its peers. Its forward PE ratio is approximately 21x, which is notably higher than GN Store Nord's, sitting around 15x.
Big difference there.
Yeah. However, it's broadly in line with market leader Sonova, also around 21x. This suggests the market views Demant and Sonova as premium assets in the publicly traded space, likely due to their larger scale, strong vertical integration, and perhaps more consistent, robust profitability compared to some rivals.
But you mentioned it's a puzzle when compared to its own historical valuation. How does its current multiple stack up against its past?
That's right. While it may appear fully valued relative to some peers today, its current forward PE multiple is actually significantly below its 5-year historical average of 23.9x.
Lower than its own average.
Significantly lower. Now, this historical average was somewhat inflated by periods of exceptional post-pandemic growth and market optimism, particularly in 2020 and 2021, when the entire sector saw a kind of re-rating.
Right, those boom years.
Exactly. Its PE ratio has seen wide swings, from over 51x in 2020, during the height of that post-COVID enthusiasm, down to a trough below 21x in 2022, before settling in the low 20s more recently.
So the market isn't giving them the same premium it once did. What's the market's overall stance on Demant right now, reflecting all these factors?
This valuation dynamic presents a central analytical puzzle, really. The company appears expensive relative to some peers on certain metrics, but inexpensive relative to its own past historical peaks.
A bit contradictory.
It is. And this suggests the market is very much in a wait-and-see mode. Investors are no longer willing to pay the peak multiples seen during the 2021 boom. They've now priced in the realities of slower growth compared to those exceptional years, the margin pressures for the changing sales mix we talked about, and the significant execution risk tied to the Kindy acquisition. The current valuation reflects an acknowledgment of Demant's historical quality, strong market leadership, and those robust long-term tailwinds. But with a clear discount applied for the heightened near-term uncertainty and the need for successful execution on its strategic and financial objectives. Show me the money, essentially.
Okay, so we've laid out the bullish arguments for Demant, the strategic plays it's making, and the financial landscape it's navigating. Let's now try to summarize the key risks Demant faces as it moves through this pivotal period. What are the most pressing challenges that could potentially derail their ambitious plans?
That's a critical lens through which to view Demant's prospects, absolutely. The primary near-term risk, as clearly demonstrated by the H1 2025 results, is macroeconomic and consumer risk.
We saw that impact already.
We did. Demant's performance shows a distinct sensitivity to overall economic conditions and consumer cautiousness, particularly in that vital U.S. market. While hearing loss is undeniably a medical need, the purchase of a high-end hearing aid represents a significant discretionary expense for many households.
It's a big-ticket item.
It is, and one that can often be deferred during periods of economic uncertainty, high inflation, or job insecurity. This makes their top line susceptible to broader economic trends.
That certainly makes sense. What about the constant, intense competition in this oligopoly? How does that factor into their risk profile?
That leads directly to competitive and technological risk.
Mm-hmm.
The hearing aid market is an intense oligopoly, as we've discussed, and this environment breeds continuous pressure from the big fives.
Constant pressure.
Constant. This translates into persistent pricing pressure, aggressive market share battles, and exceptionally high R&D demands. Companies must constantly innovate just to maintain their position. There's always the inherent risk of a disruptive technological breakthrough from a competitor.
Something out of left field.
Exactly. Perhaps a completely new way to process sound or a radically different form factor, something that could rapidly alter the landscape and render existing technologies less competitive. Maintaining R&D leadership is a costly but unavoidable imperative in this space.
And then, of course, the elephant in the room, the Kind acquisition. What are the specific execution and integration risks there?
Right. Execution and integration risk from the Kind acquisition is perhaps the most acute and significant near-term challenge. Integrating Kind Group, with its 650 clinics and 3,000 employees, primarily in a different country, it's a monumental operational undertaking.
Huge complexity.
Huge. Failure to successfully merge cultures, harmonize IT systems, standardize clinical processes, or achieve the projected revenue and cost synergies by the 2028 target could lead to a permanent impairment of shareholder value.
Not delivering on the promise.
Precisely. Moreover, the financial risk is equally substantial, with that temporary increase in leverage to 3.5x net interest-bearing debt to EBITDA. This elevated debt burden makes the balance sheet more vulnerable during the critical 18-24-month deleveraging period, making strong execution absolutely paramount to reduce financial strain.
You also highlighted earlier how sensitive their profitability is to where and how they sell their products. That seems like a persistent risk, too.
It is indeed, and that's the margin and mix risk. As clearly demonstrated in the H1 2025 results, Demant's consolidated profitability is highly sensitive to shifts in its sales mix. A higher proportion of sales occurring in lower ASP geographic markets or through lower margin channels,
Right.
even if overall unit sales volumes remain robust, can significantly compress group-level EBIT margins. This risk can undermine the benefits of top-line growth and make it challenging to achieve their desired profitability targets. It requires really careful management of their global sales strategy and channel focus.
It sounds like a lot of plates to keep spinning, especially during such a transformative period. But for every big challenge they face, Demant also has some pretty strong weapons in its arsenal, doesn't it?
It does.
It's like they've built a very robust shield, but they're now putting it to the ultimate test. What are their main mitigating factors that could help them navigate these risks?
Absolutely. Demant has several inherent defensive strengths that act as crucial counterbalances to these risks. The most fundamental are the demographic drivers we discussed at length earlier.
The aging population tailwind.
Exactly. The underlying non-cyclical growth of the aging population and the increasing prevalence of hearing loss provide a strong long-term foundation for demand. essentially creating a robust floor under the market, even during economic fluctuations. This ensures a consistent and expanding addressable market for decades to come.
And their global reach helps diversify some of these pressures you mentioned.
Yes, their expansive global footprint across 130 countries provides significant diversification against regional economic downturns or specific market challenges, while their significant exposure to the U.S. market does remain a key sensitivity.
Can't ignore the U.S.
No, you can't. But having broad international sales helps cushion localized impacts. Their long history of innovation and R&D also serves as a significant defense. Demant has a proven track record of technological leadership, with groundbreaking solutions like Otacon's AI-driven sound processing. This commitment to cutting-edge research keeps them competitively ahead, allowing them to differentiate their products and command premium pricing.
And the Kindy acquisition, while presenting risks, also becomes a powerful mitigating factor once integrated, doesn't it?
It absolutely does. Assuming successful integration, yes. The expanded retail distribution network, post-Kindig, will be vast and growing, creating a significant barrier to entry for competitors and, crucially, a secure, high-margin channel to market for its own products.
Controlling their destiny more.
Exactly. This direct control over distribution reduces reliance on independent retailers and strengthens their ability to connect directly with customers. Furthermore, the pre-existing 20-year partnership between Demant and Kind should, hopefully, facilitate a smoother integration compared to acquiring a completely unfamiliar entity.
They already know each other well.
They do, benefiting from established relationships and a shared understanding of the market. And finally, Demant's management track record includes successful execution and integration of numerous smaller bolt-on acquisitions in its hearing care division over the years. That suggests a level of competence and experience in navigating M&A, albeit on a smaller scale than Kind.
So we have this dynamic interplay of significant complex risks and very strong, deeply embedded mitigating factors. How does it all balance out in your view? Does Demant's strategic focus and strong fundamentals seem poised to overcome the near-term execution and market risks to deliver sustained value?
Ultimately, that's the central question for investors and, well, for anyone watching this industry. It's undoubtedly a period of heightened challenge, demanding flawless execution on the Kindy integration and astute navigation of market headwinds. However, their strategic decisions, like the double down on vertical integration and the professional channel, combined with their inherent quality and those powerful demographic tailwinds, well, that could solidify their leadership for decades to come.
A big if, though.
A big if. It's a finely balanced situation where strategic intent is being rigorously tested by operational reality right now. Hashtag tag outro.
So what does this all mean for Demant AS? We've looked at a company with an incredible foundation, built on powerful, non-cyclical demographic trends and a smart, vertically integrated business model that offers a significant competitive moat.
Strong base.
They've made bold strategic moves, like divesting non-core assets to sharpen their focus and making their largest ever acquisition with Kindy Group, really cementing their position in key, high-value markets like Germany.
However, we've also meticulously examined the headwinds. The sensitivity to consumer cautiousness, particularly in the U.S., the intense competitive landscape of the Big Five, and the significant execution risk of integrating Kind while navigating a period of higher financial leverage.
Can't forget the debt.
Cannot forget the debt. And their decision to abstain from the burgeoning U.S. OTC market is a particularly bold strategic choice. It profoundly sets them apart, betting heavily on the enduring value and premium nature of the professional audiologist-led channel.
Ultimately, Demant is making a clear, high-stakes bet on the future of professional hearing care and on its own ability to execute one of its biggest plays ever. For you, the curious learner, this deep dive really shows how even in a seemingly stable, demographically driven industry, major strategic decisions, complex financial maneuvers, and evolving market shifts create a truly fascinating high-stakes drama.
And that raises an important question for you, the listener, to consider. In a world of increasing self-service and digital convenience, where new players are emerging to democratize access, does Demant's doubling down on the personalized audiologist-led experience truly position it for enduring premium success? Or does it risk missing a wave of broader market accessibility and potentially a new generation of customers? It's a compelling strategic tension to ponder as the hearing healthcare landscape continues its rapid evolution.